Elliott said the whole thing is a bit overblown. He may well be proved right, but this is a shadow over his legacy, and it probably makes sense for him to go earlier rather than later, given the length of his tenure.
We're seeing at the moment people sitting back and watching things happen, and then later on saying, well, that wasn't good, and it's a matter of, well, why didn't you step in and do something to start with?
Analysts say it is obviously a negative if it is introduced, and it's it's significant, 25% on products out of Mexico and Canada.
The Commerce Commission found that it didn't believe the market was as competitive as could be. But so there is real substance in what they're trying to do, but also it's not a bad look for the government.
Welcome to the Weekly Wrap, where we go over the top video stories from the past week. First up, in all the commentary on Shane Elliott's retirement, perhaps the most telling was a quote from an analyst who said customers could consider themselves better served than ANZ shareholders. Our Australian correspondent Lachlan Cahoon shows that the further you look into this comment, the more you can understand about ANZ's recent history.
ANZ Bank became the third of the big Australian banks to change leadership this year, with Shane Elliott announcing his resignation or retirement as chief executive yesterday after 9 years. The Elliott years marked a big change for ANZ, and the bank is at an interesting point with the new chief, Nuno Matos, taking over next year. Lachlan, was the Elliott move expected?
Hi, Simon. Yeah, look, expected, but perhaps happened a little early. We were probably waiting for Q1 next year for this. I mean, 9 years in a row, very unusual, very long tenure for a bank executive. But now makes sense. ANZ's under a cloud with the investigation into the allegations about its bond trading behaviour, the claims that it manipulated trading in Australian government bonds. There's an ASIC investigation ongoing. There have been 2 internal inquiries. We've seen sackings and restructuring in the markets division. So the bank's also been ignored by the government. It hasn't been on a government panel for the issuing of bonds for a while. So it's kind of in the doghouse. Yeah. Elliott said the whole thing is a bit overblown. He may well be proved right, but this is a shadow over his legacy, and it probably makes sense for him to go earlier rather than later, given the length of his tenure.
Yeah, I mean, you talk about his legacy. What changes did he actually bring to the bank?
He really changed the focus from an offshore perspective to a very big domestic focus in Australia and New Zealand. Now they're focused on mortgages and retail banking. Their traditional strength was in markets, market trading, and also in trade finance. Under the previous executive, Mike Smith, they had a big pan-Asian expansion plan. They bought banks in Indonesia, I think, and they also sort of invested very heavily in their Hong Kong franchise. So Mike Smith had a really big plan for ANZ to be like the HSBC or Standard Chartered, or compete with those banks and DBS in Asia. But Elliott really turned that around. He sounded a retreat from those markets. And his signature deal was the $4.9 billion that they spent on Suncorp, which is the regional Queensland bank. And that was really to grab a whole lot of those mortgages in Queensland. So Elliott was very much kind of meat and potatoes banking, back to the home base. It certainly sounds less exciting for us journalists, but perhaps that was the right strategy for them to take. But that's been the big shift, international to much more Australasian focus.
Right, okay. So now they're bringing in somebody from outside. Who is Nuno Matos?
He's a 57-year-old Portuguese national, currently living in Hong Kong. He spent about 15 years with HSBC running their operations in Europe and South America. Importantly, he also led their personal banking and wealth management division. So that might be an indication that the banks are going to continue in that same sort of strategy that Elliott has led. He missed out on the top job at HSBC, apparently, and was also reportedly in the frame to lead Westpac, but they went internal. So the ANZ chairman, Paul O'Sullivan, said it was like grabbing a star footballer during the transfer window. So he was available, looking for a job. So perhaps the timing of the Elliott resignation was also a little bit to do about the availability of Matos as well.
Right, okay. But you outlined the various kind of clouds over ANZ at the moment. So what are the challenges for the incoming chief executive?
Well, number one will be making sure that the $4.9 billion that they spent on the Suncorp acquisition really adds up and is integrated properly into the bank, and they can really drive some value from that. Then it's navigating the fallout from the bond trading scandal, and this probably could be why an outsider was chosen to lead the bank. Some of the internal candidates may have been a little bit tainted by the bond trading activities. We won't know until ASIC report, but maybe he got the job because ANZ board figured that it would be better to get an outsider. So he'll have to navigate the bond trading scandal as an outsider. It may be easier for him to sort of say, I'm a circuit breaker and we're moving on. But the main challenge, Simon, is the ANZ share price. If I'd invested $1,000 in ANZ when Shane Elliott became CEO, that money would be worth about $1,100 today, and that's over 9 years.
Wow.
If I'd invested money in CBA at the same time, it'd be worth about $1,900 or $2,000. So one analyst made an interesting comment. He said that that Elliott's tenure has been really good for ANZ customers, but not necessarily for shareholders, because he's spending a lot of money and investing a lot of money and trying to win new domestic customers, and it seems to be at the expense of the share price. So it didn't move much in 9 years. So to take that football analogy a little bit further, Matt Osses really wants to score with the share price to justify his job.
All right. Always up for a sports analogy. Lachlan Calhoun, thank you very much.
Cheers, Simon. Thanks.
We all want to enjoy the annual workplace shindig, but at the risk of being the Grinch, employers have to think about their health and safety obligations. Well, that's what Fiona Rotherham is covering in this week's Toil and Trouble, with the help of Simpson Grierson Senior Associate Jessica Greenheld.
It's that time of year when workplaces all over the country stage their annual Christmas parties, if they haven't already. So from a legal point of view, what are the employer's health and safety obligations when it comes to Christmas parties?
Thanks, Fiona. Well, the overarching obligation is to ensure, so far as is reasonably practicable, the health and safety for workers. So that looks at both physical and mental safety, and particularly with WorkSafe releasing draft guidelines on ensuring and managing psychosocial risks to harm. That really is quite a consideration in terms of mental well-being these days. But looking to physical safety, you'll be looking at things like whether the venue is safe, potentially looking at tripping hazards, monitoring alcohol consumption, ensuring that employees are getting home safely and that the activities that they're doing are also safe.
So alcohol can make people behave in a way they otherwise may not. So what does an employer do if an employee or others are starting to misbehave?
Yeah, I mean, people can get silly in the silly season. I think the starting point is to make sure that there are measures in place to begin with. So looking at how you can monitor and reduce potential risks that come with alcohol, potentially giving drinks tokens, having professional bar staff serving drinks, serving food alongside drinks, and then ultimately stepping in if something is going a little bit too far. We're seeing at the moment people sitting back and watching things happen and then later on saying, well, that wasn't good, and it's a matter of, well, why didn't you step in and do something to start with?
So the boss needs to still be being the boss, even at the Christmas party.
Yeah.
Most workplaces do put a time limit on when the party ends. Are they also obliged to ensure those workers get home safely, though? Because there's always the after party that can happen after the party.
Yeah, I mean, employers really do need to consider what they're doing to make sure that employees are getting home safely, whether that's organising taxis, but it's also in terms of their liability for what happens after the party, as you say. And there are circumstances where employers can become liable for things that happen even after the event, and that's, events that aren't organised by the employer, might not have a strict connection to the workplace, but are otherwise connected through things like impacting relationships within the workplace, raising health and safety concerns, or otherwise raising potential reputational issues.
So what can they do about that?
Well, the first thing would be to investigate the issue further, look into things and check to see whether there is actually a sufficient connection to the workplace. One of the leading cases, Hallwright and Forsyth Bar, really talks about that connection. That was a case not connected to work parties, but where a senior investment manager had gone and assaulted a cyclist during a road rage incident, and the absolute fury of members of the public and their clients and other members of staff meant that the employer could, in that circumstance, take employment action against the employee.
Right. What's been other case law around this in terms of Christmas parties?
There are numerous cases in terms of Christmas parties, but around kind of out of the work event space, what happens after, you leave the function. There's one case involving a company called Tyco, and in that case, an employee had left the party. It was held at a local tavern and had assaulted a member of public, essentially punched them unconscious on the pavement outside. And the employee during that day had been advised by his employer that he was attending a work function. He was going to be identified as a staff member because he was going to be wearing his uniform, and he was essentially representing the employer there. And the authority noted in that case that the employee wasn't actually identifiable as an employee because he had his logo on his uniform covered. He was leaving the event, so not actually in there at the moment, but he was still sufficiently connected to his employment that his employer could take action. And that was because his actions had first reduced the employer's image in the minds of the witnesses and the victim himself, but also, it had been talked about by the rest of the staff members and their families and friends, and the employer had to be engaged in police proceedings as a result.
So with all these sort of hazards that can occur, what's the trend? Are people still doing Christmas parties?
I definitely think so. They are a highlight in work calendars still, and I think it's important to be rewarding staff for hard work and letting them have fun, but it's just making sure that you're messaging expectations from the outset. You're involving employees in the planning so that they know what you're expecting of them, and also can have a say in what is going on, and then addressing issues pretty promptly when they arise.
And so it's a case of, if things do go wrong, doing a proper investigation afterwards as well.
Yeah, absolutely. I mean, sometimes investigations aren't necessary if it's pretty clear what's happened, and particularly if an employee has admitted fault. But if the circumstances are unclear, if there are certain factors that need to be considered, then sitting down, taking a formal proper investigation, issuing terms of reference, letting employees know what their rights and obligations are, and then if the investigation finds that there is potential misconduct to be addressing, taking a really robust disciplinary process as well.
What a year the champagne bottles must be popping at F&P Healthcare after a stellar surge, with their share prices just starting to level off after rising more than 60% in the past year. Here's Fiona Rotherham.
The share price of listed respiratory healthcare company Fisher & Paykel Healthcare has risen more than 60% in the year following two strong halves of financial results. Joining me now to discuss the company and its performance is journalist Fiona Rotherham. Fiona, so what's behind this share price rise?
Well, the company's going through what one analyst described as a purple patch. It's performing really strongly. It's had two strong halves that it's reported on. Margins are getting back to the target levels that they're seeking almost. In another couple of years it'll be back there. So it's doing really well. It's performing well. Medtech stocks got sold off last year. There was a bit of concern around the threat of GLP-1 drugs, which are obesity, etc. drugs, right. And what impact that would have on the obstructive sleep apnea products.
Yep.
That sort of risk has gone away, or it hasn't sort of panned out the way they feared. So investors have re-rated med stocks. ResMed's also up, one of their major competitors, a similar amount. So, and overall, the market's really rewarding growth stocks. They're really saying companies that are doing well, that have got this high growth, they're really backing. So it's benefited from all of those things.
What about innovation? Has that played a role?
It's always been an extremely innovative company, but during the COVID boom times when their masks were in high demand, they increased their R&D spend to 11% of revenue, which is really high by New Zealand standards. And so they're just starting to reap the fruits of that, R&D pipeline starting to come through. And a lot of their guidance in terms of the growth they're expecting is coming from new products they've released in the last year or two.
Well, let's talk about that. What two areas of new products is the market pricing in this company's current valuation?
So there's two that are particularly standouts, I think. One is in the area of anaesthesia. So around 2022, it launched some products in that space, a cannula that anaesthetists use. They don't break out that particular revenue figure in their line, but they're saying that it's now grown to 10% of their new apps consumables revenue line, and so it's significant growth in that area. And the other one is in the non-invasive therapy area. It's kind of sits in between where F&P Healthcare has traditionally operated in the market. So Philips has been a big player in that market, been really dominant. And it's kind of in the naughty chair with the regulator at the moment. Okay. So it's had a lot of product recalls, and it's kind of spat the dummy and said, well, we're going to stop supplying these products, certain products in the US only. So that's left a gap for these competitors, and Fisher & Paykel are well poised to sort of, take up some of that market share.
But speaking of the US, and everybody is concerned about this, what about the threat of tariffs that Donald Trump is saying he's going to bring in all around the globe?
Yeah, well, it is talk at the moment.
Yeah.
So F&P are saying they can't speculate on that at the moment. Analysts say it is obviously a negative if it is introduced, and it's it's significant, 25% on products out of Mexico and Canada. Fisher & Paykel Healthcare have a campus in Tijuana in Mexico. It makes about 45% of its production there, mainly its consumables side. So it would have an impact. Just how much is really difficult to assess. But one of the mitigating factors is that it does have the ability to pass through any cost increases, because it's there's no ready substitutes in terms of the hospital side of the business, not so much the home care. And the other thing is the government might carve out healthcare products from any tariffs, because it's a big spender on this item itself, so it'd have to foot the bill.
As well, okay. So you mentioned the purple patch as being described for the stock, but is the stock now overvalued?
I think it's really at the high end of the range. If you look at what the analyst range of target prices for it, it's ranging 38.25 to sort of 30.10, and the stock's went as high as 39. It's come back a bit actually now. It's trading around $36 at the moment. You'd have to say it's pretty highly priced. It's 54 times its price earnings multiple, which is really high compared to its peers. So I think it's a great company and it's doing really well. And if you've got the stock, you probably want to hang on to it, because it will pay off in the long term. But I think you'd be paying a lot if you're paying now. It's expensive.
And finally this week, the government announced its plan to take on the 4 big Australian-owned banks by letting Kiwibank raise more capital. But is it a policy of substance or simply a piece of political grandstanding? Our political editor, Brent Edwards, speaks with Simon Shepherd.
The coalition government is getting serious about taking on the big 4 Australian-owned banks. And to talk about its plans, I'm joined by NBR's political editor, Brent Edwards. Brent, why is the government intending to let Kiwibank raise capital of about $500 million?
Well, it's following on from sort of recommendations by that Commerce Commission market study into the banking sector. It found that it wasn't competitive enough, and it kind of suggested one way of dealing with it might be to leverage up Kiwibank. So the government's saying if it can raise $500 million in capital, that will enable it to actually take on those big Aussie banks a bit more. It'll give it a bit more clout to lend more. According to the Finance Minister, Nicola Willis, it could either lend perhaps $4 billion more in business lending or $10 billion more in home mortgages, and so start to have a crack at the Aussie banks.
Right, but is this a path to partial privatisation? It it's not selling any existing shares in Kiwibank, but obviously a capital raise, and to be clear, it says it would restrict it to New Zealand KiwiSaver accounts or institutional investors or other investors, New Zealand investors. But they, by putting in $500 million of capital, that would give them a share of the bank. So in a sense, it's a partial privatisation. Interestingly enough, earlier in the year, the Treasury advised on this and also talked about a public share offering, and which was its probably preferred option because it felt it would maintain the Kiwi identity of Kiwibank more. But at the moment, Nicola Willis says Kiwibank isn't ready for a public share offering, but that's something that might happen in the future, because if investors are going to invest in it, they're going to have some way of getting their money back. And if it's not through a share offer like that where they could sell to just individual investors, then there'll have to be some option offered where they could sell back to the Crown. Okay. How else does the government intend to increase competition in the banking sector?
Look, the other sort of announcement around this, which got less less sort of play within the announcement actually, and obviously coverage, is that the Finance Minister's also written to the Reserve Bank around its financial remit and basically, directing it to sort of change some of the rules and make it easier for new entrants to get into the banking sector. But, basically there's an argument that current regulations, if you like, favour the incumbents, particularly those 4 big Australian-owned banks. So, she wants changes which will make it easier for new entrants, particularly, the fintechs, the innovative new, institutions that you might not recognise as traditional banks. But, I think everyone's arguing that banking is changing, and she wants to put much more pressure on the existing banks to move much more quickly to open banking so that people can change banks much more easily, compare banks, compare mortgage rates and that much more easily than they can at the moment.
I just wonder whether this is actual, progress to disrupting banking, or whether the government is playing politics by having a bash at the Aussies.
Look, I think it's a bit of both. There is some substance in trying to open up the banking market to more competition. Although there are already, even if you look at 4 banks, there are 4 banks competing, large banks, and as well as a number of smaller banks. So, but the Commerce Commission found that it didn't believe the market was as competitive as could be. But so there is real substance in what they're trying to do. But also, it's not a bad look for the government. They're not going to be hurt politically by seen to be smacking the Aussie-owned banks. So they're doing it with gusto.
Yes.
They're doing it in the Select Committee too, at the Finance and Expenditure Select Committee. National Party MPs and ACT Party MPs are really giving the banks a hard time when they're turning up there. So they obviously think there's a lot of political mileage at the moment in giving the banks a good kicking.
And thanks again for joining us. Our news team is back from 5 a.m. tomorrow with the latest business news you can use on mbr.co.nz, and join Mike McRoberts from 5:30 p.m. tomorrow for a look at the day's top stories. See you next week.